This is the second part of the presentation for Chapter 14, Long-Term Liabilities. In this learning objective, we will discuss the accounting for long-term notes payable. Accounting for long-term notes is similar to accounting for bonds. Also, accounting for long-term notes payable is similar to notes that are current liabilities. However, we must consider the time value of money with long-term notes because they are due much later in the future. First, we determine the present value of the note and then amortize any discount or premium over the life of the note. To illustrate a note that is issued at face value, we will consider the $10,000 three-year note issued by Scandinavian Imports to Bigelow Corporation. The stated rate and the market or effective rate are both 10%, so there will be no discount or premium on the note. When Scandinavian receives the $10,000, they would debit cash and credit notes payable. The interest expense would be recorded each year by debiting interest expense and crediting cash for 10% of the $10,000 or $1,000. If a company issues a zero interest-bearing note, they receive the difference between the face amount and the present value of the note instead of making periodic interest payments. The difference between the face and proceeds is the discount, which would be recorded and amortized to interest expense over the life of the note. To illustrate accounting for a zero interest-bearing note, we will consider a three-year $10,000 zero interest-bearing note issued by Turtle Cove Company to Jeremiah Company. The implicit or understood interest rate on the note was 9%. Therefore, Turtle Cove received the discounted amount of $7,721.80 at the issuance of the note. No interest payments will be made during the 3 years, and Turtle Cove will pay the $10,000 at maturity. To record the receipt of the cash proceeds, Turtle Cove would debit cash for $7,721.80 and discount on notes payable for $2,278.20 and credit notes payable for the maturity value of $10,000. This slide shows the amortization table for the note. There is no interest due on the note, but the discount, $2,278.20, would be amortized over the life of the note using the effective interest method. The interest of $694.96 for the first year would be calculated by multiplying 9% by the carrying amount of $7,721.80. The interest would be a debit to interest expense for $694.96 and a credit to discount on notes payable for the same amount. Turtle Cove would continue to amortize the discount each year, and at the end of the 3 years would debit notes payable for $10,000 and credit cash for $10,000. Companies frequently issue notes for property, goods, and services that they receive. Interest may be imputed when notes do not bear interest, or the interest rate stated is unreasonable, or the face amount of the note is materially different from the current cash price for the same or similar item. If the company cannot determine what the fair value of the property, goods, services, or other rights are, and if the note does not have a ready market, then it may be necessary to impute an interest rate on the note. In determining the appropriate interest rate to impute on a note, accountants should consider prevailing rates for similar notes, but also consider factors such as restricted covenants, collateral, payment schedules, and the existing prime interest rate. To illustrate imputation of interest, we will consider the note issued by Wunderlich Company on December 31st, 2020 to Brown Interiors Company for architectural services. The note has a face value of $550,000. It is due in 5 years, at December 31st, 2025, and bears interest at 2% payable at the end of each year. The question is whether the 2% interest rate on the note is appropriate. Wunderlich cannot readily determine the value of the architectural services, and the note is not readily marketable. However, based on Wunderlich's credit rating, the absence of collateral, and prevailing interest rates, the company determines that an 8% rate is appropriate for the note. Therefore, it will be necessary to impute an 8% interest rate on the note. This slide shows the calculation of the present value of the note, $418,239, and the discount of $131,761. Like the calculations for bonds in the first presentation, the present value of the principal, $374,319, is determined by multiplying the face value of the note, $550,000, by the factor for a single sum for 5 periods at 8%, 0.68058. The present value of the interest payments, $43,920, is determined by multiplying the $11,000 annual interest payments by the factor for an ordinary annuity for 5 periods at 8%, 3.99271. The $11,000 interest payments are based on the original 2% interest on the note. To record the issuance of the note on December 31st, 2020, Wunderlich would debit buildings or construction in process for the present value, $418,239, debit discount on notes payable for $131,761, and credit notes payable for $550,000. This slide shows the amortization table for the note. The first two columns show the dates and annual interest payments of $11,000. The third column is the interest expense column. The interest expense for the first payment, $33,459, is calculated by multiplying the carrying amount of the note, $418,239, by the imputed rate of 8%. The discount amortization is the difference between the interest expense of $33,459 and the cash paid of $11,000, or $22,459. The discount amortization is then added to the $418,239 to arrive at the new carrying value of $440,698. The entry to record the interest expense for 2021 is a debit to interest expense for $33,459 and a credit to discount on bonds payable for $22,459 and a credit to cash for $11,000. At the end of the 5 years, the discount would be completely amortized to interest expense, and Wunderlich would pay the principal of $550,000 to Brown Interiors Company. Mortgages are the most common long-term liability. They are issued when a company pledges title to property as security for a loan. Mortgages may be payable in full at maturity or may be paid in installments. They may carry a fixed or a variable rate of interest. Companies will report as current liabilities the mortgage payments due within the next year or operating cycle, with the remainder of the principal due as a long-term liability. In this learning objective, we will discuss how to present and analyze long-term debt. Companies now have the option to report the fair value for most of their financial assets and liabilities, including bonds and notes payable. In fact, the FASB believes that fair value measurement for financial instruments, including financial liabilities, provides more relevant and understandable information than amortized cost. When companies choose the fair value option, non-current liabilities are reported at fair value, and the unrealized holding gains or losses are reported as either part of net income or as other comprehensive income. Changes in the fair value of liabilities based on interest rate changes are reported as part of net income, and changes resulting from the credit rating of the company are reported as part of other comprehensive income. To illustrate the reporting of bonds at fair value, we will consider Edmunds Company that issued $500,000 of 6% bonds at face value on May 1, 2020. Edmunds chooses the fair value option for the bonds. At December 31, 2020, the value of the bonds is now $480,000 because interest rates in the market have increased to 8%. As interest rates increase, the fair value of the bonds decrease. Therefore, to record the fair value, Edmunds would debit bonds payable for $20,000 and credit unrealized holding gain or loss income for $20,000. It's important to remember that it is the amortized cost that is compared to the fair value each period to determine the fair value adjusting entry. Companies continue to amortize discounts and premiums each period to determine the carrying value to compare to the fair value before making the appropriate adjusting entry. To illustrate the other type of fair value adjustment, we will consider that the changes in the fair value of the Edmunds Company bonds was not due to interest rate changes, but was due to Edmunds' credit rating dropping from AA to BB. In this case, Edmunds would still debit bonds payable for the $20,000, but they would credit unrealized holding gain or loss equity instead of income. The credit to comprehensive income instead of net income reflects the concern by the FASB that declines in a company's credit rating should not result in recording additional income when the value of their liabilities drop. Since companies do not want their credit ratings to drop when they acquire more debt, some have turned to off-balance sheet financing to borrow. Two methods used are to record debt in a non-consolidated subsidiary or in a special purpose entity. In both cases, the debt would not appear on the company's financial statements. However, the FASB has taken steps to curb these tactics by having stricter requirements for consolidation and for reporting of guarantees of indebtedness regardless of whether the probability of payment is remote. Some of the rationale that companies provide for off-balance sheet financing are shown on this slide. As we mentioned earlier, removing debt does improve the quality of the balance sheet, which facilitates obtaining more credit at a lower cost. Loan covenants, which may limit the amount of additional debt that a company can carry, is another reason that companies seek off-balance sheet financing arrangements. Last, some companies will argue that the asset side of their balance sheets are severely understated, which makes the calculation of ratios such as debt to assets appear much worse than if fair value for all assets were reported. In reporting or in presenting long-term debt, companies must include the nature of the liabilities as well as other important information such as maturity dates, interest rates, etc. The fair value of their debt must also be disclosed if they are using amortized cost. Companies also must disclose future payments including sinking fund requirements and maturity amounts of long-term debt for each of the next 5 years in the notes to the financial statements. This disclosure allows analysts and users of the financial statements to make better decisions regarding the company's ability to meet their future obligations. One important ratio related to long-term debt is the debt to assets ratio, which is calculated by dividing the total liabilities by the total assets. The higher the percentage of liabilities to total assets, the greater the risk that the company may be unable to meet its maturing obligations. Times interest earned is another important ratio that indicates the ability of a company to meet interest payments as they come due. This ratio begins with net income but adds back interest and income tax expense in the numerator. The sum is then divided by interest expense. The higher the times interest earned ratio, the easier it is for the company to meet interest payments as they come due. This slide shows the debt to asset and times earned ratios for target. It is important to remember that single ratios by themselves really are not very useful. Ratios are most useful when they are compared with other years or industry averages to determine trends and relative standings with similar companies. In the appendix for this chapter, we will discuss the accounting for debt restructuring. Troubled debt restructuring occurs when a company grants concessions to a debtor due to the debtor's financial difficulties. As shown on the slide, the difficulties usually begin with a recognition of loan impairment. This can be signaled by the late payment or inability of the debtor to make periodic interest and/or principal payments. If the conditions continue, the creditor may make a modification of terms to keep the debtor in the loan. If the problems continue to escalate, the debtor may enter bankruptcy, at which time the creditor will settle the debt at less than the carrying amount. Settlement of debt can involve either the debtor transferring non-cash assets to the creditor or the issuance to the creditor of the debtor's stock. The creditor should account for the non-cash assets or equity interest received at fair value. To illustrate settlement of debt, we will consider where American City Bank loaned $20 million to Union Mortgage Company. When Union Mortgage fails to meet its loan obligations, American City Bank agrees to accept real estate with a fair value of $16 million in full settlement of the loan. The real estate has a carrying value of $21 million on the books of Union. The entry by American City Bank to record the transaction would be a debit to land for $16 million and a debit to allowance for doubtful accounts for $4 million, a credit to notes receivable for $20 million. The bad debts expense and allowance for doubtful accounts would already have been recorded earlier when American City Bank determined that there was an impairment to the loan. Union Mortgage would record the settlement of debt by debiting notes payable for $20 million, loss on disposal of land for $5 million, and crediting land for $21 million, and gain on restructuring of debt for $4 million. If American City Bank instead agrees to accept 320,000 shares of common stock from Union Mortgage that has a fair value of $16 million in full settlement of the loan, then the entry would be a debit to equity investments for $16 million, a debit to allowance for doubtful accounts for $4 million, and a credit to notes receivable for $20 million. Union Mortgage would record the transaction with a debit to notes payable for $20 million, credit to common stock for $3,200,000, credit to paid-in capital in excess of par for $12,800,000, and a credit to gain on restructuring of debt for $4 million. The credit to common stock is equal to 320,000 shares times the $10 par value for the stock. The difference between the fair value of the stock, $16 million, and the par value of $3,200,000 is equal to the credit to paid-in capital in excess of par. Prior to settlement of debt, the creditor will try to modify the terms of the loan to keep the debtor from defaulting. This slide shows some of the modifications that might be offered. Frequently, the modification may include all of these. The FASB chose a method which results in the debtor recording transactions differently from those recorded by the creditor in order to avoid debtors reporting large gains on restructuring. When we review the creditor's entries, you will see that they are different from those recorded by the debtor. The main difference between the two is that the debtor does not determine the present value of the future cash flows resulting from the modified terms. The debtor compares the undiscounted future cash flows to the amount remaining on the original loan to determine if there is a gain on restructuring. If the undiscounted future cash flows are not less than the amount due on the original loan, no gain is recorded. In this illustration, we are going to consider a modification of terms that would not involve the debtor recording a gain on the restructuring of the debt. In this illustration, Mortgage National Bank grants concessions to Resorts Development, which is experiencing financial problems. The first concession is to reduce the principal from $10,500,000, the amount currently due, to $9 million. Also, the bank extends the maturity date from December 31st, 2019 to December 31st, 2023 and reduces the interest rate on the loan from 12% to 8%. The interest rate will be 8% of the reduced principal of $9 million or $720,000 per year. The future cash flows are $9 million in principal and $2,880,000 in interest payments for a total of $11,880,000. Since this amount is greater than the amount due of $10,500,000, no gain will be recognized by Resorts Development Company on the restructuring of the loan. This is the amortization schedule for the restructured loan. Part of each of the $720,000 interest payments will be applied to interest expense and part to reduce the loan balance from the current amount, $10,500,000, to the $9 million. The amount due at the present time, $10,500,000, is treated as the present value. The future interest payments, $720,000, and principal $9 million, are the future cash flows. The interest rate that sets the present amount, $10,500,000, equal to the future cash flows is 3.46613%. To record the first interest payment, Resorts Development would debit notes payable for $356,056, interest expense for $363,944, and credit cash for $720,000. At the end of the 5 years, Resorts Development would pay the $9 million principal to Morgan National Bank and debit notes payable and credit cash for $9 million. Morgan National Bank would determine the present value of the future cash flows of the restructured loan as shown on the slide. The bad debts expense, $2,593,428, is the difference in the amount due on the original loan before restructuring of $10,500,000 and the present value of the future cash flows of the modified loan, $7,906,572. To record the entry, Morgan would debit bad debts expense for $2,593,428 and credit the allowance for doubtful accounts for the same amount. This slide shows the amortization schedule for the restructured loan for Morgan National Bank. The interest payments are now $720,000, but the bank still records interest revenue per the original loan at 12%. The difference between the two amounts is debited to the allowance account. To record receipt of the first interest payment, Morgan will debit cash for $720,000, allowance for doubtful accounts for $228,789, and interest revenue of $948,789. On December 31st, 2023, when Morgan receives the principal payment, they would debit cash for $9 million, debit allowance for doubtful accounts for $1,500,000, and credit notes receivable for the $10,500,000. Your textbook has another example for modification of terms where a gain on restructuring would be recorded by Resorts Development that you can review. These are the quiz hints for Chapter 14. Please remember that it is best to complete the homework before attempting the quizzes. This is the review information for the problems for Chapter 14, and this is the end of the presentation for Chapter 14, Long-Term Liability.